Welcome back. Futures are indicating a decline at the start of trading this morning. Take a look. Dow Industrial is now down at the lows of the morning, down 193. The S&P is down 25, and the Nasdaq down 121. We're watching earnings. A big day again. American Express, Verizon, both reported a double beat on earnings and revenue this morning, but both stocks are down. People worried about the guidance. American Express is down almost 5%, and Verizon is down 2.25% right now. Joining me right now is ERShares CEO Joel Shulman. Joel, good to see you. Thanks very much for being here. What are you expecting from the macro story? Are you in the camp that we're going to see some serious curveballs and economic slowing in the year ahead?
No question we're going to see economic slowdown. I mean, we've got rising interest rates. You announced a few minutes ago that the 10 years now, the highest it's been in a long time. We're seeing a lot of action in the yield curve on the very short period. So under 1 year, in fact, the highest rates for the yield curve and the 30-year yield curve is at 1 year at 4.6, almost 4.7%. And so we're seeing a lot of action in the short term, which indicates more and more rate hikes, which is certainly going to dampen the enthusiasm for the market. At some point, the housing data is going to kick into the CPI, which is a lagging indicator. At that point, we're going to see the inflation starting to subside, and we're going to see the markets recover. A year from today, we think the markets will be much higher. We think we may have a Christmas rally depending on the December rate hike. But the next few months, we're going to see revised expectations similar to what we saw today. Forward earnings are going to be coming down.
Well, I'm glad you mentioned housing, because that's certainly one area that you can see the direct impact of higher interest rates. We had existing home sales for September out yesterday, down for an 8th month in a row, 8 months down to a 10-year low. We've got more housing data coming out next week, Joel. But when you take a look at a mortgage rate, 30-year, hovering around 7%, that is more than a double just from a year ago. That's created demand destruction, people walking away from contracts and from mortgages.
No question. When you see interest rates going from 3 to 7%, more than doubling, you're going to have the cost of the homeowner is certainly much higher. What's interesting is a CPI does not yet reflect that. It's, again, a lagging indicator called based on something called the OER, which is a rent indicator which lags by 6 to 12 months. So we saw CPI going up last month primarily because the CPI is based 30 to 40% on housing, which doesn't kick in for about 6 months to a year. So, and by the way, we saw CPI rise last month unexpectedly, despite the fact that energy went down. This month, we're seeing energy going up, and so the CPI next month may also be disappointing, even though on the ground we're seeing energy prices. But for the OPEC cut in production, we would have seen energy prices continue to drop, but OPEC kind of threw things off by a month or two.
Well, it's a good point to make, because people are expecting some sticker shock when they get their heating bills this fall. That's why I don't think that inflation has peaked yet. Food prices have not shown much movement at all on the downside. You look at a dozen eggs, it's up 30% year over year. But, Joel, I want to get your take on how people are investing around all of this. What are you seeing from your ETF business, especially since we're also looking at currencies? The Japanese yen at the lowest level now since 1990. The dollar has been showing such strength. That's cutting into international earnings.
Yeah, no question. So we're seeing, ETF actually. Surprisingly, last week we saw money come. Well, I don't know if it's surprising. Money came in last week. We're going to continue to see it choppy every once in a while. I mean, we're seeing fits and starts. So Thursday was last week. We saw an unusual period where it was down considerably in the morning, came back strong. It's only happened like that 9 times in the last 40 years. Friday came back, really down. Monday came back really up, and then we saw choppiness through this week. We're going to continue to see choppiness through the next CPI reading. The Fed comes out pre-CPI. So the Fed comes out 2nd and 3rd of November. I don't think we're going to see any real surprises there. Another 75 basis point rate hike. Then we have CPI coming out mid-November, November 10th. We're probably not going to see much surprise there. What's going to be really interesting for in terms of the next month, I think the December period, when we see December CPI, if we start to see some movement there and we see inflation starting to peak and subside, then I think we'll see the markets recover. And certainly a year from now, when you look at the yield curve, you see it peaking at 1 year and 3 year. It's appreciably higher than the 10-year and 30-year.
Have people been investing in that way? What are they doing in terms of ETFs right now, Joel?
They are investing episodically. I mean, they're coming in strong in certain days. We're seeing some movement coming in. We are seeing flows. So some people are sensing that we're closer to the bottom than the top. So we are seeing flows coming in, generally speaking, we're seeing a lot of movement back and forth. But we have seen inflows, generally speaking, in the last couple of weeks. And I think we're going to see towards the end of the year, we're going to see money coming back in. There's a lot of money in the sidelines right now that is sensing we're coming closer to the bottom.
All right, we will leave it there. Joe will be watching. Thanks very much for being here this morning. Joel Shulman joining us on markets and investing today. Quick break, and then there's the Biden border crisis. It is bleeding